As mentioned in prior videos, deductions from an employee's paycheck can be either pre-tax or post-tax. Let's take a closer look at what that means. Pre-tax deductions are deductions that are withheld from an employee's gross pay. That means that these deductions reduce the taxable income of the employee. Pre-tax deductions are voluntary deductions that have been legislated by federal government as eligible for pre-tax withholding status, including certain types of insurance, retirement plans, and cafeteria plans. Let's look at one common pre-tax deduction, insurance. It's common for employers and employees to share the cost of health insurance. The business determines how much the company pays and how much the employee pays. To qualify for pre-tax status, the insurance plan must meet the IRS requirements that the health plan is offered through the state's small or group large market, an employer's self-insured health plan, the DoD's non-appropriated fund health benefit program, a governmental plan, COBRA health coverage, or retiree health coverage. In 2010, the Affordable Care Act was passed, providing small businesses a tax credit for providing health insurance coverage when their employees are at a low and moderate income levels. The Act extended coverage of children until the age of 26 to be included as an option to employees on a pre-tax basis. Another option many employers are offering is additional health and disability insurance coverage that is entirely paid for by the employee. One of the largest providers of this type of insurance is Aflac. Long-term disability is excluded from taxable income under IRS Revision Ruling 2004-55. If an employer pays for long-term disability insurance, these amounts may be excluded or included in gross pay depending really upon the election of the company. When determining the tax treatment for the supplemental health insurance, the IRS guidance provides the following. If the income derived will be estimated to be tax-free, then the cost associated will also be tax-exempt. However, supplemental health and disability plan premiums are not tax-exempt for Social Security and Medicare, basically FICA taxes. Let's also talk about retirement plans. Retirement plans have two different types, defined benefit and defined contribution. A defined benefit plan means that the employee will receive a certain amount each period after they retire, whereas a defined contribution plan differs in that the employee contributions is a set amount, usually a percentage or a fixed amount per pay period. In a defined contribution plan, the amount received by the employer after they retire varies. There are multiple examples such as 401k, 403b, a SEP, an ESOP, a simple 401k, an IRA, and simple IRA. It is up to the employee to decide if they will, employer to decide if they will offer a retirement plan and which type is best suited for their firm. Post-tax deductions are deducted from the employee's pay after federal, state, and local income taxes and FICA taxes have been deducted. These post-tax deductions can be both voluntary deductions and court-mandated deductions. Voluntary post-tax deductions are, for example, donations, union dues, supplemental insurance, whereas court-mandated deductions include garnishments, tax liens, and child support. So let's talk about court-mandated deductions. Court-mandated deductions cannot take away the employee's entire paycheck. The Consumer Protection Act has specific guidelines about how much of an employee's pay may be deducted for each class of garnishment. Garnishments may be not more than 25% of the employee's disposable earnings, or the amount by which an employee's disposable earnings are greater than 30 times the federal minimum wage, $217.50. So in case you're wondering, disposable income is calculated by taking the gross wage of the employee and deducting all mandatory tax withholdings. One common court-mandated deduction is child support payments. When there are court-mandated child support payments that must be withheld from an employee's paycheck, the deduction may be up to 50% of disposable income if the employee is supporting more than one spouse or child, or 60% if the employee is not supporting another child or spouse. There is an additional 5% for any child support that is more than 12 weeks in arrears, meaning past due. There are other court-mandated deductions such as liens and other garnishments. The maximum amount that can be withheld from an employee's paycheck depends on the type of debt the employee has. U.S. government debts and student loans have the same maximum amount to be withheld from the employee's paycheck, which is 15% of the earnings in excess of federal minimum wage weekly earnings. Consumer credit loans, on the other hand, have a limit of 25% of the earnings in excess of federal minimum wage weekly earnings. For personal bankruptcy, the amount to withhold from the employee's paycheck is the lower of 25% or 30 times the amount of weekly income in excess of federal minimum wage. For tax levies, though, see IRS Publication 1494, which tells you how much of an employee's paycheck is exempt from levies based on the number of the dependents the employee has.